All right, let's talk about decoding the language of the charts, specifically how to spot when a market might be about to turn on a dime. We're going to break down two really powerful concepts that traders use to get a handle on this. Something called a market structure shift and the order block.
It really is the million-dollar question, isn't it? You're watching this monster trend play out, and you're just wondering, where is the top? Or where's the bottom? How can I get just one clue that all this momentum is about to completely flip? Well, that's the exact problem we're going to tackle today.
So here's our game plan. First, we'll cover the basic idea of spotting a market's turn. Then, we'll dive into our first huge clue, the market structure shift. After that, we'll pinpoint where to look with order blocks, figure out how to tell the good ones from the bad ones, and finally, we'll zoom right in on what's called the high probability zone. All right, let's dive in. Spotting the market's turn. Now, the source material we're looking at uses a pretty fancy phrase for this. It calls it a change in the state of delivery. It sounds super technical, right? But trust me, the idea behind it is actually pretty simple. Think about it like this. It's that one specific moment when the whole power dynamic in the market flips. For a while, you had the buyers in total control, just pushing prices higher and higher. And then bam, the sellers just rush in with this overwhelming force and take over. Our whole job is to find the breadcrumbs that lead to that exact moment of handover. So the big question is, how do we actually see that change happening? Well, our first major clue, our first big signal, is something called the market structure shift, or, MSS for short. I love this analogy. Think of it like the very first crack you see in a building's foundation. Okay, picture this. A healthy uptrend is just like walking up a flight of stairs, right? Every step up is a new higher high, and every little platform you rest on is a higher low. It's this beautiful, confident pattern. But the market structure shift, that's when you go to take the next step up and you miss. You stumble, and you actually fall below the last step you were just standing on. That single break, that tells you the confidence is gone. Let's walk through a classic bearish example. So first, you've got this nice, clear uptrend. Everything's going great. Then, step two, the momentum just fizzles out. It tries to make a new peak, but it just can't. And here's the kicker, step three. The price doesn't just stall, it crashes right through the previous higher low. That violation right there, that's the market structure shift. It's like the market is screaming at you, hey, this uptrend might be done. Okay, so the market structure shift is like the smoke alarm going off. It's a huge warning that a reversal could be coming. But, where's the actual fire? That brings us to our next piece of the puzzle, the order block. This is literally our X that marks the spot. So what is an order block? Well, it's basically a footprint left behind by the big players. We're talking institutional orders, the real big money. It's a specific zone on the chart where a massive amount of buyer-sell orders were stacked up. And what's so cool is that when the price comes back to visit that zone, it tends to have a really powerful reaction because those huge old orders can still be waiting there, ready to get filled. And the source material gives us this awesome way to think about it. An order block is like a giant roadblock for price. I mean, imagine price as a car just speeding down the highway. When it comes racing back towards that roadblock, it's probably going to slam on the brakes, maybe even pull a U-turn. It's a serious barrier you have to pay attention to. Now, of course, these roadblocks aren't all the same. Sometimes they act like a floor that price bounces off of, and sometimes they're more like a ceiling that price just can't break through. So that means we need to know the difference between a bullish order block and a bearish one. And honestly, telling them apart is way simpler than you might think. For a bullish order block, one where we expect prices to go up, you're hunting for the very last down candle, the last red one, right before a huge surge upwards. That's the spot where the big buyers jumped in. And for a bearish one, you guessed it, it's the total opposite. You're looking for the last up candle, the last green one, just before a massive drop. It's really all about finding that one final specific candle right before the whole game changed. Okay, this is where it gets really cool. We can actually get even more precise than just a whole zone. I mean, an order block is an area, but is there like a hot spot inside that area that's the most sensitive? Well, according to the material we're looking at, you bet there is. This special level has a name. It's called the mean threshold, and all it is the 50% midpoint of the order block candle's body. So we're just talking about the thick, colored part of the candle. You can ignore the wicks, those thin lines sticking out. And this 50% line, it's often a supercritical point of control. So yeah, that 50% mark is the number to remember. It's not just some random line in the sand. It kind of represents the fair value or the equilibrium of that whole order block. And the way price reacts when it comes back to test that specific level, wow, it can tell you a lot and really helps you fine-tune your analysis. So why does this matter so much? Well, look, price can react anywhere inside that order block zone, but if it comes back, touches that 50% mean threshold, and gets rejected, that's often considered a much higher probability signal. It's like a big confirmation that the roadblock is holding and that the reversal we're expecting is really kicking into gear.
Okay, so let's put this all together into a simple framework. A little checklist. Step 1, you figure out what the current trend is. Step 2, you patiently wait for a clear market structure shift that tells you the trend might be over. Step 3, you find the order block that actually caused that shift. And finally, step 4, you zoom in and mark that 50% mean threshold as your high probability zone. See? It's a really logical step-by-step way to look at the charts.
So think about it. You're not just staring at a bunch of random lines and wiggles on a screen anymore. Now you're actually equipped to see the story playing out, that incredible shift in power between buyers and sellers, and the exact zones where those huge battles were fought. So the real question to leave you with is, now that you know what to look for, are you ever going to see the charts the same way again?